All right, so we're going to dive into a pretty fascinating paradox from our source material. On one hand, the U.S. job market is showing some pretty serious signs of weakness. But on the other, Wall Street investors are, get this, actually hoping it gets even worse. How in the world does that make any sense?
Yeah, I know. It sounds completely counterintuitive, right? I mean, bad news for the average person is somehow good news for Wall Street. It's weird. But to really get why this is happening, we first have to look at what's actually going on in the job market. Okay, let's get into the hard data here. If you go back to the beginning of 2025, the story everyone was telling was about the strongest job market ever. But man, by the end of that year, that whole story had completely flipped on its head. And look, this isn't just some simple little slowdown. It's really a two-pronged problem. It's getting hit from both sides. So on one side, you've got corporate layoffs, and they're spiking to levels we usually only see during a full-blown recession. And on the other side, companies are hiring at the slowest pace we've seen since all the way back in 2009. For anyone looking for a job, that's a serious double whammy. Now, real quick, a little note on the data itself. The numbers from late 2025, they were a little messy. And that's because of the longest government shutdown in U.S. history. But here's the thing. Even when you account for that, the downward trend is it's undeniable. The job market is cooling off, and it is cooling off fast.
Okay, so what in the world is causing all this? Well, our source material points to three major forces that basically all collided in 2025, creating this perfect storm for the job market.
And here they are. First, you've got tariffs. Second, the absolute explosion of AI. And third, a major tightening of credit. Let's break each one of these down.
So first up, tariffs. The whole idea, right, was to bring manufacturing and jobs back to the U.S. But according to the Institute of Supply Management, they've actually led to a net loss of jobs so far. It's just a classic case of unintended consequences. Second, and this is a big one, AI. The use of artificial intelligence just absolutely exploded in 2025. And this quote on the screen, it perfectly captures the new mindset in a lot of boardrooms. Businesses are literally asking themselves, hey, why should we have this huge human workforce when AI agents are cheaper and, they don't ask for vacation time? This is a fundamental shift in how companies think about operating and hiring.
And that brings us to the third trigger, tighter credit. So in 2025, banks saw their cash reserves go down, which forced them to get way stricter about who they lend money to. And in an economy like ours that basically runs on credit, well, less borrowing means less spending, and less spending ultimately means less growth, and you guessed it, fewer jobs.
Okay, so let's recap. We've got a weakening job market, and it's being driven by tariffs, AI, and tight credit. So how does this all connect back to that original puzzle? Why would Wall Street see any of this as a good thing? Well, it all comes down to what our source calls the stimulus chain reaction. It's a playbook, and here's how it works. A weak job market signals economic trouble. That, in turn, puts a ton of pressure on the government and the Federal Reserve to do something. And what do? They respond with economic stimulus, cutting interest rates and basically creating new money out of thin air. And here is the absolute key to this whole thing. According to the source, this new money doesn't help everybody out equally, not even close. History shows that when a flood of new cash gets pumped into the system, it benefits asset owners. We're talking people with stocks, real estate, way more than it helps regular workers and consumers. I mean, this chart right here says it all. Just look at these numbers from the last 5 years. Okay, so median income, it grew by about 23%. Not bad, right? But wait, inflation grew even faster at over 25%. So that means the average person actually lost purchasing power. Their money buys less. Now, look at the stock market. It grew by a staggering 85%. This shows you exactly who wins when the money printers go burr. Asset prices just soar, and wages get left in the dust.
So if you know this is the playbook, what do? Well, our source lays out a potential game plan for how you might position yourself financially in this kind of economic system.
But first, we have to do this, the all-important disclaimer, we're just breaking down the source material here, okay? This is not financial advice. Investing has risks, for sure, and you should always do your own research. Okay, with that out of the way, the source outlines 3 basic tiers. Tier 1 is pretty straightforward, passive investing in the broad market. Think of a fund like SPY, which tracks the S&P 500. Tier 2 is a little more aggressive, a tech-focused fund like Q2Q, which follows the big tech companies on the NASDAQ. And then there's Tier 3, This is for the really active investors, the ones who are doing deep research to find those opportunities before everyone else does.
And for that passive approach, the source has this really simple, memorable acronym ABB. It stands for Always Be Buying. The whole idea is just to be consistent. You invest a little bit week after week, month after month, no matter what the market is doing. It's all about consistency, not trying to be a genius and perfectly time the market.
So after breaking all of this down, from the cooling job market all the way to this investor playbook, it really all boils down to one critical question.
And here it is. In an economy of printed money, where stimulus pretty much guarantees that asset prices will grow faster than wages, are you positioned as a consumer or as an owner? Are you the one feeling the pinch as costs rise, or are you the one whose assets are benefiting from that very system? It's a really powerful question to think about. Thanks for joining us for this Explain.